The psychology of stock market investing is always going to be a detriment in the macro because you're going to live in a world of confirmation bias, which basically means you always know somebody out there that's a perma bull and somebody that is a perma bear. And depending on how you feel and how you've been kind of manipulated by the news in the media, you're going to lean more in one of those directions and primarily only listen to the good or only listen to the bad. But the whole point of investing is for long-term capital gains, and you do not want a confirmation bias on the stock price itself. You want to dig into companies and find out what is going to make them bullish long term and live off the facts rather than the fiction of the macro, and then don't worry about it for the next 3 to 5 years. And I've got two people we're going to be listening today. One of them bullish as all hell, Tom Lee, calling for a violent rally coming into February. And then we got people like Meet Kevin, who thinks we are heading into something the exact opposite. I'm going to show you some clips, and if that's something that interests you, consider hitting that like button, folks, because first and foremost, we got to talk about the stock market here because we are in the mix of one of the most interesting earnings seasons I can say we've had in a while, because leave it up to Google to basically save the entire S&P 500, guys. They're doing a 20-to-1 stock split, so my 5 shares are going to become 100. And again, for a lot of people that don't understand what that means, basically just take the current price of Google, divide it by 20, and then just that's what you're going to get in share payout. It doesn't increase or lower the value. It doesn't do anything from a statistical standpoint that really matters to value, other than people are going to have an easier time options playing this, and people psychologically, especially in Canada or outside of the US where it's harder to do fractional shares, are going to be like, hey, I can afford Google now. It's only like a couple $100 a share. But nonetheless, guys, very happy with Google. I'm not buying, I'm not adding to it here. I think this news is a little violent, and I would still expect more volatility into this year, at least in the first quarter or two. So maybe if you're into Google, try and get the dips. Perhaps if you can save up money, I would get into it before the split, because historically stocks do really well after splits. But this has led up to what is going to be a pivotal earnings in my portfolio, because many of you know I have two major conviction trades going on. Well, not trades, long-term investments, I should say. That is Facebook and that is Tesla. Facebook still being the largest position in my portfolio after the record volume of sales and basically being the most downloaded app with their Oculus VR platform over the holidays. I'm very excited and anticipating that these Q4 results are going to be just as good, or hopefully at least anywhere near at par with what Google posted. So I'm going to be doing a full breakdown of Google, of Facebook in my next video. So consider subscribing for that, guys. But it is nice to see some leveling off in the market. I mean, going across the board here, we still are relatively flat, but things are rebounding. I think my portfolio is actually sitting at all-time highs, thanks to a few capital contributions and just the fact that the Canadian markets are now about 2% away from their all-time highs, guys. So having that global exposure definitely offers some stability against the volatile and violent actions that go on in the US stock market. But putting that aside, guys, I got to show you this video because everyone's talking about Tom Lee. So take a quick listen.
Yeah, the setup looks like the V for February is not Valentine's, but violent rally. There's a couple reasons for that. One is that we know retail sentiment got so negative that it was the worst since 2013, but the last 6 times it was this negative, 6 out of 6 times the market was higher 3 months later. The second is retail cash. We're going to talk about this with our clients tonight, but if you look at retail money market cash from ICI, retail investors basically assumed a bear market was starting. So they've raised so much cash in the last couple of months that we're essentially resetting a risk-on rally. And the third is, I mean, this is anecdotal, but I've been at a couple conferences over the past week. I didn't find anybody bullish. So I think when institutional investors are cautious, retail basically priced in a bear market and their sentiment's the worst in 8 years, meaning you should expect a violent rally.
So Tom Lee gets criticized a lot because he is a perma bull, and he thought the December Christmas rally was going to be insane, and it wasn't. Now he's saying that we've hit kind of this ultimate bear fear in the market. And honestly, when it comes to being bearish in the market, guys, we're going to listen to Meet Kevin in a second. You cannot take that in strides. You should always be in the market. This comes back to like people thinking the real estate market's overvalued. But if you honestly care about real estate, you're good at doing value adds, and you dig around, there's always a deal somewhere. And this is primarily the problems I have with Meet Kevin, because he lives in a particular aspect of the market that is the most volatile, the most risky, where trading is more prevalent than long-term investing, in my opinion. And honestly, it's kind of detrimented his audience because he always preaches the idea of long-term passive investing. And before I speak too much on what Kevin's going to say, I want to reiterate that I am a huge Tom Lee fan. I think the guy always has interesting insights into the market, and it kind of hinders my own confirmation bias of being a perma bull within the market. But I'm a perma bull based off diversification, not off buying a few assets that are extremely volatile and risky, and crossing my fingers that it's going to work out. So let's listen to Meet Kevin, and I got a few comments on some of the stuff he said.
About Tom Lee, basically this guy who's always on CNBC talking up how great the market is and buy the dip on everything. And I know I've always been a big fan of buy the dip. I've obviously gotten concerned about what I believe will be a Federal Reserve overcorrection before things get better. Could always be wrong. It's just worth noting that Tom Lee, all of last year, was a bull, including 2 months ago when he's like, the Santa Claus rally will dominate Wall Street. It's this whole article about basically how we're going to the moon in December, and December was a terrible month. But the difference is it pays to be a perma bull because everybody loves a perma bull. And I'm very bullish long run, like 3-4 years out for America. I'm a little more nervous for the next couple of years.
So Meet Kevin said something very crucial in what he said there, which is he thinks being bullish on America in the next 3 to 5 years is going to bode well for investors, but he's very hawkish on the near term thanks to the Federal Reserve probably under anticipating inflation, likely going to drastically increase interest rates. And to be honest, from an emotional, tolerated investor that listens to this on the Buy Daily, the only thing you can do to protect yourself from this, because you do not want to not be in the market, especially when you see Google shoot up like it has been. And I mean, you're going to miss out on any of those capabilities coming from a few secular aspects of the market. But the whole point, guys, is to stack some cash. If you're bearish, stack some cash, buy some risk off plays. I mean, that could be anything from the commodities market to the financial systems to your dividend plays, your industrials, things that are going to be a little bit more hedged and offer cash flow and stability, because obviously people will always need toothpaste, guys. People are still always going to need fuel, things of that nature. Now, though I don't buy into a lot of different things, everyone has their own opinion. I just feel like it's ignorant to shell out an idea that people shouldn't, be constantly cost averaging into what's going on here. Because if Tom Lee is right and we do get a violent rally, Meet Kevin could be right in the near term, but that doesn't mean stocks don't go fly up to all-time highs and then we see a 15% correction. Like, the timing the market is what Kevin is doing that I would call gambling. Nobody actually knows what is going to happen, and this is no different than people playing an earnings call. For instance, you could see companies, especially right now, when like Microsoft posted earnings and the stock dropped 7% in after hours and then rallied back 5% the next day. Like, you cannot predict what the markets are going to do. You don't understand the inflows and outflows of trillions of dollars, no matter how much you want to pretend based off news articles the Fed drops that actually indicates what the markets are going to exactly do. It's just too impossible, and you have to recognize when you're gambling. And that's, in my opinion, what Meet Kevin tries to do as entertainment on his channel. I just don't think it's the best iteration for people that are those long-term cost averaged investors, because these are the real opportunities in finding dips when they come up in this volatility to take advantage of them, guys. Because even if the market drops 20-30% tomorrow, and I say this about all my holdings, if you are buying individual stocks, you should completely appreciate and understand the fact that those things could drop 50% tomorrow for whatever black swan event reason. If that is not something you are capable of handling, then you are not investing in the right assets for your risk tolerance. This is a really broad view conversation, but I pass the question off to you guys. Are you a perma bull? Are you a perma bear? And I hope you're always able to find the middle ground, because confirmation bias is what's going to ruin your investments in the near term. Because you've got to remember, near-term thinking is gambling. Long-term investing is what always wins out. But stay cool, stay awesome, and I look forward to catching you in the next one.